everyone. We're all very excited to be here today. And first, let's set the table. So thinking about equity markets 2024, equity long-short funds up anywhere from low to mid-teens on average. Long-short spread, best year since 2010. And of course, the S&P up 23%, more than 23%, with the top 10 stocks contributing 67% of returns. And so that really begs the question, what does 2025 look like? So a lot to think about from the GP and LP perspective. So why don't we first get into interjections before we really kind of dive into the topic. So let's go down the line. If you can introduce yourself and your firm.
I'm Geeta Kapadia. I'm the Chief Investment Officer at Fordham University. We are based in New York City with campuses in the Bronx and at Columbus Circle.
I'm Cowen. I'm the founder of Suvretta Capital. We run about $3 billion in two strategies, a diversified long-short fund and a biotech fund.
Hi, I'm Imran Khan. I'm the founder and CIO of Proem Asset Management. We started the fund 6 years ago, long-short equity in technology.
Hi, I'm Yoon, Chief Investment Officer of New York Life Investment Management. New York Life as a company is about $750 billion, 400 is third party. And I chair Asia business.
Great. All right, well, let's get right into it. So Geeta, you oversee an endowment portfolio. Would love for you to talk about how you're thinking about equity expectations across the portfolio, and if there's anything that you're doing tactically for 2025.
Yeah, so we're big believers in the equity markets. We try and follow the endowment model to the extent that it makes sense for our portfolio. Having previously worked at Yale's Academic Medical Center, David Swenson and the Yale model are very near and dear to my heart, and I grew up with them. So we think a lot about them, although they're not always relevant to a much smaller endowment than Yale's. However, we do try and adhere to some of the primary kind of philosophy with regards to that model. So we are believers in growth. We particularly need growth just to grow the base for which we operate the university. It's really important to us to be able to provide scholarships, to provide funding to students, particularly given that we have a very large base of first generation and students of color and underrepresented students. So for us, every dollar is really important. So we do think that equities for us is the place to be, particularly public as well as private equities. Tactically, we're not really doing anything terribly different. We're very keenly aware of geopolitical risk, the changing administration, all the impact that they may have on some of the largest companies in which we're invested. But we're kind of doing what we usually do, kind of adhering to the way that we think about growth and continuing to try not to be adversely swayed by what's going on in the news.
Great. All right. Well, why don't we think about where we are today? And, Aaron, I've heard some people compare the environment today to call it the late 90s, maybe 2005 to 2007. You've been doing this job for a little while, so would love to kind of get your perspective on where you'd place us.
Yeah, well, I've been in the hedge fund business now 28 years, which I'm embarrassed to say it's been that long. Given I was a child of the 80s, actually, I think this is going to be like the 80s. It's very analogous. You had a Democratic administration under Carter. You had high inflation. You had regulatory issues. You had a hostage crisis. I think, history tends to rhyme. You have a new administration coming in, super pro-business. They are, looking to get inflation under control. And I think it's going to be a good time. So, if people think that this will be a short period of time, I think it's going to be like the rest of the decade is going to be really exciting. And, given that, obviously I'm a little biased given we run a longer biased hedge fund. But I think people are going to want to own equities, and it's going to be fun the next couple of years.
All right. Well, Jay, what are your thoughts?
Yeah, I agree with wanting to own equities. It's just a matter of where and when do you pivot away. For me, from middle of last year, I've been pivoting away from large cap, particularly S&P that's tilted to tech, and moving to mid cap and maybe SMID, but S&P 600 small. That's worked out okay, and then December came, and well, January's playing out So I want to start shifting away from, I guess, S&P skewed to the Meg 7 in the U.S. And also, I've been dabbling around in overseas, but U.S. exceptionalism beyond President Trump, it's just very difficult to make a rational argument to jump into any of the overseas market. However, I have some tactical views about structural reform in Japan and maybe tactical play in China, et cetera.
And where, when we had a prep call, we talked a lot about the yuppies of the 80s. So
Yeah.
would you kind
Sorry.
of compare us to the 80s, or would you think more late 90s?
Yeah, no, well, the reflection on the 80s for me comes from inflation is heading down. So it's continuing to decline. However, given the current changes in Trump administration or changes being implemented by Trump administration, I do worry about second half of this year that if we get a whiff of inflation coming back, second wave as they call it, then things could change quite drastically. Somebody said to me, so I don't want to take credit for this statement, but it resonated with me. You can trade the you can buy the Trump-driven corrections or declines, but if you get inflation-driven decline in equities or some kind of correction, I don't see a recession, but then I wouldn't try to buy that dip, and I think I'd agree with that.
Great. All right. Well, I want to bring Imran into the conversation just because there's been a little bit of news in the tech space recently. I don't know if anyone has heard of DeepSeek, but obviously this is very close to what you do. So, when we talked last week, this wasn't necessarily even on the topic for discussion.
But things change very fast.
Things change very fast, and we had to pivot. So would love your thoughts on that and AI, and obviously if you have any thoughts in terms of the market overcorrecting, what's real, what's not real about all the hype.
So what happened with DeepSeek is very significant. I think if you go back 2 months ago, if we were having this conversation, there was a debate that is AI will be proprietary and some large 7 companies will have all the powers. And if you are a small company, I was a chief operating officer of Snapchat, what do you do? I think what DeepSeek proved that AI will be democratized. So if you are an investor at AI Lab, rethink about it. All these companies spend all this money building proprietary model, and it's ultimately will become commoditized. I think Facebook is doing that. 50% of the market is already open sourced, and it will become commoditized. And as it becomes commoditized, I think it's great for other 495 companies that out there, because now they can get those LLM at a very, very cheap price, and you can build product and services on top of it. So I think it'll be a very interesting time in the market for stock picking, because when there is significant change, there will be winners and losers. And winners and losers will be directed by companies who has a lot of data, a lot of distribution capabilities, because a great product without distribution means nothing. So you need great distribution. And it will also depend on execution, because not everybody will be execute well, right? Because fundamental change, when we went through the mobile revolutions, not everybody executed well. When we went through the .com era, not everybody executed well. So the execution will become very, very important. And I used to be an operator before starting the fund. Idea sounds great, but execution is very different. So I think it'll be a very, very interesting market in terms of, finding winners and losers, and long short going to be very, very interesting, because, couple of years ago, you only could be long or you only could be short because market was driven by macro trend. Now you will find winners and losers.
Sounds like a good sell for long short. So, Aaron, would love your thoughts just on this topic. When we were just chatting now, you said that this was actually creating a lot of opportunity. So
yeah, so what DeepSeek did, in my opinion, is it's an efficiency tool. Like, look, no one knows what it really costs. No one knows the exact answers, what the implications are. But what it's going to do is going to make AI cheaper for people to use. So if you also think about it, when you have tech revolutions, like, look, you had the creation of the iPhone and the mobile phone. okay, that happened in like the late 2007 when the phone launched, and most people had a smartphone by the early 2010s. Then you had things like Uber were created, right? So, AI is going to be the same. You built out the infrastructure, which is the training models with NVIDIA. Now, what is going to be the killer application? The next, I guess it's phase 2 or phase 3 of the AI trade. And what was the catalyst? I guess, as Imran was saying, we didn't know this would be the catalyst. This is probably the catalyst. And it's exciting, right? And that's the great part about the market. So now you have a bullish administration, pro-business. You saw last week they were doing all these announcements to build out AI. That's going to continue. It's going to make AI cheaper. And companies are going to innovate and create products and applications. And that's where hopefully long-short managers like us can make a boatload of money.
And you're not just talking about Tesla because Elon's brother floating around. No, I'm totally joking.
Yeah.
Jay,
He doesn't need me to tell him how good he is.
Jay, I think, did you have something you wanted to interject on? Or?
No.
Okay. Great. Imran, so would love your thoughts, on tech as well, just beyond AI, Mag 7, just in terms of where you're seeing opportunity elsewhere, maybe in SMID tech. We had some interesting conversations in the lead up, so would love for you to talk through that.
Yeah, I think we're looking at a lot of fintech businesses. Some of these names are, I'm on the board of a company that we invested called Dave. We also invested in Nubank in out of Latin America. So we're also looking at companies that have a lot of data and in the software space that they can leverage those data in the AI front. So that's one of the areas that we are significantly making a lot of investment. I also think we're going to see going back to pro business, there will be a lot of M&A coming back. We haven't seen M&A for a long period of time. And so I think we're looking at companies that maybe not appreciated in the market, but could be a great M&A candidate. We talked about in the past, in 2018, when Trump was president, there was a lot of M&A in the software space, and that really helped a lot of funds. So we're looking at a lot of those areas as well.
All right, Geeta, would love your thoughts just on the tech space. So we had talked about how you really like tech in the endowment portfolio. So would love for you to kind of talk through that and what expectations are within that space. And then also, how do you monitor for any sort of unattended bets across the portfolio, specifically when it comes to tech?
Yeah, we are, the panelists have said it very well. We think there's a very exciting opportunity for the portfolio, for our portfolio, to have exposure to companies, and Imran said a few companies that we're already exposed to through our managers' funds. Particularly given the community that we serve, we think there's huge opportunities for us to leverage, not only within the endowment, but just across the university. There's opportunity within educational technology, within healthcare. We have a student-run fund, we have a student-run angel fund, and so we're trying to think about all of the different ways in which we can exploit the advantages we already have being where we are and who we are to identify opportunities that may not end up in the endowment, but may be beneficial to the university in some way. So we do think a lot about educational tech. We think a lot about, particularly during coming out of COVID, where we had to suddenly deploy online learning to hundreds of students who are craving that, and their parents who are paying tuition bills, who want to see that their children are actually getting some value out of that tuition. So we think a lot about how to leverage some of that technology that we've now become accustomed to and have learned the pros and cons of using. With regards to our portfolio, we really spend a lot of time with our investment managers. So we've found that to be the best way to learn what they're investing in. And so, although obviously we scrape data, we want to get the quantitative measures of what the portfolio looks like. At the end of the day, a lot of that data could be stale, and so having those real-time conversations with our managers, even if it's just every month, every quarter, to understand the way they're thinking about the landscape and where they're seeing new opportunities. For us, that's our best way to kind of navigate what the holistic portfolio looks like, and then make sure that we're not suddenly doubled down on spaces that, as we've said, can move very, very fast.
Yeah, a lot to look after for sure. So why don't we shift gears away from tech, because there's a whole other world out there, although sometimes it doesn't feel like that. Aaron, would love your thoughts in terms of where you're finding opportunity elsewhere outside tech, outside the Mag 7. Obviously, you run a diversified portfolio, so.
Yeah, so I would say, we find opportunities in lots of different spaces. I think the financial space is actually probably the most interesting. We already just talked about M&A, boom. If you think about, again, my 80s analogy, if you remember, investment bankers were hot. So I think the investment banking industry is going to be incredibly exciting in the next couple of years. I think there's lots of ways in the financial space, and also just having a regulatory environment. The CFPB might go away. That will be more friendly. That tends to be good for banks, and people are pretty creative who work at these places.
And then why don't we also think about things a little bit more globally as well? So Jay, you were starting to talk a little bit about some of the opportunities that you're finding elsewhere. Can you elaborate a little bit more on that, especially under the context of the current administration, tariffs, U.S. exceptionalism? Do investors continue to pivot to U.S. markets, or is there more to be had elsewhere?
So for me, I respect that U.S. is exceptional beyond anything Trump has done yet, President Trump has done yet. Because as you look around the world in 2024, you really had only U.S. to invest for, right? So as I look at 2025, I still, when you look at the broad economy, Main Street, I do think U.S. may be still exceptional. However, from pure valuation perspective and, as turning points go, I do think sometime in 25, you have to start looking elsewhere. For me, I started betting on China very tactically. I don't have a long-term positive view on China either. However, there's just going to be a lot of fiscal spending that's going to stimulate. Now, there has to be a little bit of belief there. Europe, I also think it could be a spring coil. I just don't know how to play it, because structurally, there's a lot of problems, and I don't see any fiscal or any kind of floor being set. With China, there's actually maybe a Z put option, if you will. Japan, I've been structurally positive. I've been in and out in the last 2 years. I went in pretty aggressively a couple of years ago. I pulled back. There's rally Japanese equity that's structurally probably a couple more years of reform to play. Currencies, the reason I tactically reduced, but I'm looking to rebuild.
Great.
So that's kind of how I look at the world. Yeah.
Okay, awesome. Well, I appreciate the views on tech, outside tech, the global perspectives. Geeta, one last thought. S&P end of 2025. What do you think?
I'll say 7.
Okay, wonderful. Well, that was very quick. So thank you all so much. That was fantastic. Thanks to the audience, and we'll wrap it up.
Thank you very much.